Thank you, listeners, for joining Mayer Brown's Global Financial Markets Initiative teleconference series. Today's call is titled The New 2021 ISDA Definitions, Part 1, an Overview. I'm Edmund Parker, and I'm Global Head of the firm's Derivatives and Structured Products practice. But first, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again and forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we're not having a Q&A session, please do send your questions regarding today's topic by email to gfm@mayerbrown.com and we will respond promptly. That's the same email address as you have on your invitation email. Today, in an action-packed call, we are discussing the following. We're discussing the background and history of the ISDA definitions and how the 2006 ISDA definitions transition in to the 2021 ISDA definitions. We're looking at the structure, implementation, timeline, and impact that the 2021 definitions will have. We will be looking at floating rate options and new naming conventions and the matrix concept which we have in the new 2021 definitions. We're looking at the inclusion of risk-free rates and RFR calculation methods, the new fallback sections, the general integration of the benchmark supplement and the integration of the IBOR fallbacks protocol approach into the ISDA 2021 definitions. We'll also look at the new cash settlement approach, as well as some of the other notable changes, such as calculation agent and business day provisions. Now, a brief introduction of our speakers for today's call. For me, Ed Parker, my practice covers all areas of derivatives, but in particular the sections regarding interest rate derivatives that we're talking about in our topics today. And I'm delighted to be joined by my colleagues Chris Arnold and Patrick Scholl. Chris Arnold is a partner in Mayer Brown's London Derivatives and Structured Practice. Chris focuses on derivatives and structured products and acts for the world's leading investment banks as well as other financial institutions, end users, trustees, service providers and industry groups. Patrick Scholl is a partner and head of Mayer Brown's banking and finance practice in Germany. Patrick leads the Mayer Brown capital markets and derivatives offering in Germany with a European focus. And with those brief introductions, we turn to the topic at hand. So I'm going to kick this off with a look at the background and the history of the ISDA definitions and how the 2006 ISDA definitions transition into the 2021 ISDA definitions. Well, the ISDA definitions provide the backbone for interest rate derivatives contracts. They provide the standard terms. They provide the elections. They provide the fallbacks, which get incorporated by reference and then amended in transactions into all cleared and uncleared derivatives transactions. And they began life, the ISDA definitions, almost 35 years ago with the 1987 ISDA interest rate and currency exchange definitions, which were published in 1987. Back then, the definitions were a fairly short document, but ever since then, with each round of updates, they've started to increase in size. And the 1991 ISDA definitions were the first major update, bringing in new definitions such as additional currencies. I was leafing through this the 1991 definitions the other day and noticed that the standard form confirmation included a telex agreement. So that even preceded fax as being a dominant form of communication. And the 1991 definitions were supplemented in 1998, which again expanded the currencies, the floating rate options. It added negative interest provisions, swaptions, and more sophisticated termination rights. And that 1991 defs, as supplemented by the 1998 update, was again updated with a new set of definitions, the 2000 definitions, which wrapped up the changes of the supplement and included provisions for the brand new currency, the euro. Then followed the last major update in 2006, the 2006 ISDA Definitions. This updated the 2000 version, adding more rate options. There'd been an annex to the 2000 ISDA Definitions published in the meantime. That too was wrapped up into the 2006 ISDA Definitions. And that was the last big update of the ISDA Definitions. And for the last 15 years, we have seen new rate options and market developments, including some pretty major ones, such as the provisions for the transition from the IBORs to risk-free rates, being dealt with via supplements to the 2006 ISDA Definitions. And these have been released periodically on an ad hoc basis, sometimes only weeks apart, and have been over 70 of these supplements. So that's it makes a huge catalogue of supplemental definitions. And the 2006 definition is also supported by 3 matrices. There's a mark-to-market matrix for mark-to-market currencies, a matrix for early termination and swaptions, and a collateral cash price matrix, with each matrix providing standard elections which can be incorporated into individual transactions to create documentation efficiency. Now, 2006 definitions, they've worked well, but they're quite unwieldy, and change really is required. So ISDA's Benchmark Reform Working Group has been working to produce the new 2021 ISDA definitions for some time, and it's very much a evolution rather than a revolution, building on what we have already, consolidating the supplements and making necessary changes. So I want to take a look at what will the 2021 ISDA definitions look like. Well, they're released on the Monday, the 17th of May, and the new definitions are divided between a main book, what's called a main book. So that looks rather like the 2006 ISDA definitions, i.e., that's your main piece of documentation. It's 220 pages long. It has 5 matrices, which are the currency business day matrix, the settlement matrix, the floating rate matrix, the mark-to-market day matrix, and the compounding averaging matrix. And each of these matrices provides standard elections which are incorporated into applicable trades. My colleague Patrick Scholl will discuss these in a moment. The main book consists of 18 sections, and it covers the sort of things that you'd expect from previous versions. So sections on business days and currencies, dates and periods, fixed amounts, floating amounts, and similar. But it also has further changes that are brought in. So these key changes include for floating rate options, a transition to having these set out in long form towards a matrix structure, payments of floating amount terms, which are updated with new business day calendars and conventions. For example, there are provisions to capture unscheduled holidays. So, for example, in an emerging markets jurisdiction, if there's an announcement to close, to have a holiday to make sure all the banks are shut on a particular day, the new provisions for unscheduled holiday are brought in and covered within the definitions. Calculations under the new definitions are normally set out now as formulae instead of in narrative form, and there's a continued movement towards a generic framework for fallback rates and adjustments for floating rate options. There is much, though, that is not changing in the definitions. The IBOR fallbacks introduced by supplement number 70 to the 2006 ISDA definitions with much fanfare earlier this year, and the accompanying risk-free rate floating rate options and their compounding methods, fixed amounts and floating amount determination methods, that's all being transferred across. Much of the arrangements for mark-to-market swaps, swaptions, physical settlements and rounding, as well as much else of the good things in the 2006 ISDA definitions, remain with no or little change. So, but what will change is how the 2021 ISDA definitions are published. Goodbye paper PDFs. The new definitions will be published in an electronic format assisted by an interactive web-based interface. Goodbye to supplements 2. Changes are to be made through publishing full new versions of the 2021 definitions. So no more trying to piece together 70 or so supplements. The idea is that the user will be able to surf the interface and pick up a consolidated version of the 2021 ISDA definitions, which applied as of the trade date. And that's a considerable improvement. The interface will also facilitate a comparison between different versions based on their publication date. Whether or not there will be a protocol, though, is still undecided. A protocol would allow derivatives users to update their forerunner ISDA definitions govern trades to the new 2021 ISDA definitions. Consultations are ongoing as market participants consider the tax, clearing and margining effects of global change. So the 2021 ISDA definitions are scheduled to be published on 4th June 2021. The target implementation date is the weekend of 2nd and 3rd October, and the definitions will become market standards on 4th of October. The 2006 ISDA definitions will not disappear, though. Unamended, they will continue in legacy transactions unless there is a protocol solution. They may also continue to be used by some market counterparties, much as previous versions of the definitions have lingered on long after they've been replaced. We think, though, that a complete market move is more likely, as ISDA said that it will stop maintaining or updating the 2006 ISDA definitions following the implementation weekend. Importantly, most of the major clearing houses have announced that although they will accept new trades for clearing which incorporate the 2006 ISDA definition, these trades will be cleared subject to the 2021 ISDA definitions. And there have been some indications from other venues that they will only allow the trading on the basis of the 2021 definitions. So I now pass to my partner Patrick Scholl to discuss floating rate options and new naming conventions and the matrix concept. Patrick, over to you.
Thank you, Ed. I will now give you a brief introduction into the changes and updates made in the 2021 ISDA interest rate derivatives definitions in respect of the floating rate option. In the following, I will use many of the newly used terms in the definitions to enable you to familiarize with them. The benchmarks to which a transaction relates are now called underlying benchmarks in the definition. One of the main structural changes in the 2021 definitions is the way how floating rate options will be prescribed in the definition. Let me start with the introduced two new concepts about floating rates, reference rates in the definition. The definitions differentiate between the so-called screen rates and the calculated rates. Screen rates are directly published rates like the Euribor. For a specific designated maturity, the value of this underlying benchmark will be shown on a screen and directly included in the calculation of the floating amount. There are different styles of screen rates. Screen rates are term rates, overnight rates, a swap rate, or any other rate specified in the confirmation. Calculated rates, on the other hand, are rates that are based on a specific underlying benchmark and a certain calculated rate style. For examples for these specific underlying benchmarks are the new risk-free rates like SONIA, SOFR, or ISDA. The calculated rate style is a certain mathematical method. The definitions therefore provide for the so-called compounded floating rate options, average floating rate options, the possibility of a specific formula, or the use of an index, like the SOFR index. The relevant calculation styles and their specific variants and modules are set out in the new section 7 of the definitions. Here you will find many of the formulas for the so-called compounding with observation shift method, the compounding with look-back method, which is also known as lag method in the DCM area, or the compounding with look-back method. Ed will give you some more information in a few minutes about these. These methods go beyond the previously published supplements 55, 57, or 59 to the 2006 definition for SONIA, SOFR, or ISDA, and are drafted in a way to provide for the necessary flexibility to adjust the interest rate swaps to interest rate structures in underlying hedging instruments like bonds or loans, which are not yet clear going forward how they will look like. The new floating rate option definitions with respect to the underlying benchmarks are no longer fully set out in the definitions in a narrative style. Instead, a new matrix, the so-called floating rate matrix, will be used to determine the elements for each floating rate option. This means that the main book of the 2021 definitions provides for the abstract modules of the floating rate options only, and all specific identification terms and all other applicable provisions will be set out in the matrix, which always has to be read together with the main book. For the purposes of the matrix, a new naming convention has been developed to make the names of the floating rate options more consistent going forward and to make an identification easier. For example, the floating rate option for Euribor, initially named as EUR minus Euribor minus Reuters, is now named without its source as EUR minus Euribor. The floating rate matrix then sets forth with respect to each floating rate the category, i.e. whether it is a screen rate or calculated rate, and the applicable style of the floating rate option, i.e. whether it is, for example, a term rate or a compounded floating rate option. Further, the underlying benchmark, the designated maturity, if any, the fixing date and fixing time, the administrator, and the applicable temporary and permanent fallback provisions are prescribed. The matrix will enable the 2021 definitions to smoothly adjust over time, if necessary, and we expect many updates going forward, in particular the inclusion of new underlying benchmarks going forward. With that, back to you, Ed.
Patrick, thank you very much. I'm now going to continue the discussion a bit further with a look at the inclusion of the new risk-free rates. So what's happening here under the 2021 ISDA definitions is to wrap up the big changes that occurred in January this year with the introduction of the 2020 ISDA IBOR fallbacks protocol. Now, Patrick's going to talk a little bit further about that in a moment, but what that protocol was looking to do was to deal with the fallout of the IBOR rates which transition to the new risk-free rates. So those new risk-free rates being rates such as SOFR for US dollars and SONIA for sterling, ISDA for euros. So of course we have the definitions of those new rates are included in the 2021 ISDA definitions, and they're following, really wrapping up what we had in Supplement 70 to the 2006 ISDA definitions, which was what was brought in through the fallbacks protocol. But of course it's more complex than just having definitions of new risk-free rates, because whereas LIBOR was a forward-looking rate, i.e. the LIBOR rate was established at the start of any interest rate period, the new risk-free rates are backward-looking rates, so they can only be established at the end of a particular interest rate period, and that can only be done, or that is done, on the basis of a five-year historical median rate. So having those adjustments, that is all to moving from forward-looking to backward-looking rate, and how that is done with a backward shift of observation period. That's all taken across from Supplement 70, and it's put into the 2021 ISDA definitions. Of course, the IBORs will cease in the future, and they will cease apart from certain of the USD LIBOR rates, will cease at the end, being representative at the end of this year, with certain of the USD rates meeting the same fate in June 2023. So the 2021 ISDA definitions are covering that transition as well for existing trades where these are where those trades are updated to the new definitions. Alternatively, the new rates are not used. So that to do that, there's also the concepts of spread adjustments that are built in to deal with any transition, and these take account of the new risk-free rates not having a credit element to them, but the former IBOR rates having that as well. So these provisions all transitioned across. Plus, Supplement 70 was not the end of the changes that were made to the 2006 ISDA definitions to cover the transition away from IBORs. Further supplements have been coming out, which cover risk-free rate indices and SONIA indexed rate options as well. And these too transitioned across. So the whole new world for risk-free rates as we move away from IBORs is also captured in the 2021 ISDA definitions. And with that, I'm going to pass back to Patrick again to discuss in some further detail the new fallback sections, the general integration of the benchmark supplements, and also the integration of the IBOR fallbacks protocol approach a little further. Patrick, over to you.
Thank you, Ed. A material new part of the 2021 definitions are the provisions regarding fallbacks for underlying benchmarks in sections 8 and 9. The update of the definitions now fully takes into account the LIBOR developments in the past and the lessons learned therefrom, in particular the fact that an underlying benchmark might no longer be available during the term of a transaction. Also, the regulatory requirements, for example, on robust written plans under the EU benchmark regulation, are the basis for this fundamental new part of the 2021 definition. It therefore is based on the developments formed by ISDA in the past, in particular the ISDA benchmark supplement and the ISDA 2020 IBOR fallbacks protocol. The fallback provisions are split into two parts. Section 8 provides for generic fallback provisions and Section 9 sets out bespoke fallbacks. In each case, the provisions differentiate between the trigger on the one hand and the legal consequences, i.e. the fallback, on the other hand. Let me start with Section 8. Section 8 first deals with the potential temporary non-publication of the underlying benchmark. For example, with the trigger that the underlying benchmark is not published by its administrator on a certain fixing day, which is called the standard temporary non-publication trigger. As a consequence, one of the temporary non-publication fallbacks in line with floating rate metrics for the specific floating rate option applies. These fallbacks relate either to an alternative rate method, the previous day's rate, a reference bank call, or a calculation agent determination. With respect to a permanent cessation, the 2021 definitions provide for the general trigger of an index cessation event and its definition. This definition includes the known trigger from the IBOR protocol, relating to published statements about the cessation of the benchmark by the administrator or supervisor. In addition, a non-representative trigger event might apply if set out in the floating rate matrix. The floating rate matrix or confirmation can also provide for any other trigger event. As a consequence of the occurrence of a permanent cessation trigger, the bespoke or the general fallback provisions of the 2021 definition can apply. This is all set out in the floating rate matrix with respect to all floating rate options. The generic fallback provisions are structured in a waterfall way, starting with an agreement by the parties or replacement of the underlying benchmark by a pre or post or calculation agent nominated benchmark, including adjustment payments, and ending with the possibility of a non-fall termination in certain cases. Finally, Section 8 provides for the administrator benchmark event. This definition has been brought over from the ISDA benchmark supplement, but it is now drafted in a more generic way and no longer primarily relates to the EU benchmark regulation only. The administrator benchmark event occurs, in short, if based on publicly available information, the underlying benchmark may no longer be used to perform obligations under the transaction. Whether it applies or not to a transaction is regulated by the floating rate matrix. The same applies with respect to the legal consequences, which mostly are the same than in the case of a permanent cessation scenario. Section 9 then is more specific to the generic provisions in Section 8. It provides for specific temporary and permanent fallbacks for certain floating rate options. In this section, the material parts of the 2021 IBOR fallback protocol can be found with respect to, for example, US dollars LIBOR, sterling LIBOR, or Euribor, with a few changes thereto compared to the sub-protocol. But also specific provisions for certain risk-free rates are now there, can be found there as initial underlying benchmark of a transaction, like SOFR, SONIA, or ISDA. With that short overview of this important part of the 2021 definitions, I'm closing my part of this presentation and hand back to Ed.
Thank you, Patrick. I now pass to Chris to discuss the new cash settlement approach and some of the other notable changes in the 2021 ISDA definitions, such as calculation agent provisions and business day provisions. Chris, over to you.
In addition to the anticipated structural changes to the architecture of the definitions and the revisions to the floating rate options already discussed, the cash settlement provisions will undergo a considerable overhaul from the approach taken in the 2006 definitions. By way of reminder, these cash settlement provisions apply whenever the optional early termination or mandatory early termination provisions are applicable in an interest rate or cross-currency transaction. They're also used to determine the payout on cash-settled swaptions. In general, the cash settlement amount is intended to reflect the mark-to-market value of the relevant transaction at the time of early termination. However, there are many different ways in which this value could theoretically be determined. Regulatory reforms, including the shift to mandatory margining of derivatives, as well as changes in pricing methodology since the financial crisis, have led to calls for ISDA to take a fresh look at how these provisions work, and the 2021 definitions have provided the ideal opportunity for a new approach. As part of the 2021 definitions project, ISDA formed a working group which sought feedback from market participants on establishing new, clear, robust and objective methodologies for determining the cash settlement amounts in the context of optional termination, mandatory termination, and settlement of cash swaptions. In addition, the working group sought to establish a consensus on which methodology should be the default position for each termination scenario, what fallbacks would apply in situations where the primary methodology could not be used, and what options would be available to the parties to further modify the position. Of particular note was the question of whether the cash settlement amount should be determined based on a mid-market theoretical valuation approach, based on assessing the present value of the cash flows under the transaction without applying any valuation adjustments, or on a replacement value approach, based on the cost of replacing the economic value of the transaction for one of the parties, which is referred to as the protected party. This distinction between the mid-market valuation and the replacement valuation is important, as the outcome in terms of the value of the cash settlement amount can vary significantly. However, the answer to the question of which approach is the most appropriate is nuanced, and the preferred approach in any particular transaction may depend on the purpose of the inclusion of the early termination provisions in that transaction. To take an example, where a transaction that applies optional termination has been priced on the basis that it would continue to maturity, it could be argued that the party exercising the option should pay the other party the replacement value of the transaction to permit that party to enter into a replacement trade in the market. On the other hand, where the option has been included in order to protect the exercising party from having to continue to perform in the face of a deterioration in the creditworthiness of its counterparty, it may be more appropriate for the party that exercises the option to receive the replacement value so that it can replace the trade with a more creditworthy counterparty. However, where the parties are simply taking a position with respect to the future value of interest rate swaps, a mid-market valuation that provides both parties with equal exposure may be justified. Ultimately, both approaches will be included in the 2021 book, with the expectation that the mid-market valuation approach would normally apply for both optional early termination and mandatory early termination scenarios, with the ability of the parties to elect the replacement value or other methodology in the confirmation. whereas the approach for swaptions would continue to be determined on a currency-by-currency approach and largely follow existing market conventions. Both the new mid-market theoretical valuation approach and the replacement value approach are designed to address perceived limitations in the existing methodologies, in particular emphasizing the use of indicative quotations in the case of the mid-market approach or firm quotations in the case of the replacement value approach to obtain an objective determination where the parties cannot agree the amount. Where there is no such agreement, the settlement amount is based on the arithmetic mean of quotations received from 5 reference banks that the parties may agree up front in the confirmation. A detailed look at all the other features of the methodologies is beyond the scope of this presentation, but I want to just highlight a few key elements of each approach. Firstly, under the mid-market valuation approach, the quotations sought must, first, be for the net present value of all of the remaining payments under the transaction. Second, be at mid-market, the midpoint of the bid and offer quotations. Third, the quotations must be indicative. Fourth, they must be based on a prescribed methodology. And the prescribed methodology includes an assumption that the parties are trading under a standard 2002 ISDA master agreement, and that they either then elect whether they're trading with no credit support annex or the existing credit support annex that exists between the parties, or a reference variation margin collateralized credit support annex with cash-only collateral. The prescribed methodology also provides that the quotes given must be used the same discounting curve to determine the present value of the payments. That discounting curve is either derived from the methodology in the credit support annex or agreed up front in the confirmation. Finally, if insufficient dealer quotations are obtained, the fallback is for the calculation agent to determine the valuation based on the same prescribed methodology. Under the replacement value approach, the key elements include the following. First, the quotations sought must be firm quotations, reflecting the fact that the party that is facing the termination of the transaction will have to enter into that replacement transaction or may choose to do so at the price that it's offered. Second, the parties must identify which party is the protected party in the confirmation. This is the party that must be able to replace the transaction being terminated. Third, the documentation and collateral arrangements that apply are the actual terms existing between the protected party and the quoting reference bank, or, if no documentation is in place, a standard 2002 master agreement and variation margin credit support annex with cash collateral only. Fourth, the settlement amount is based on the best quotation obtained, that is, the lowest cost to the protected party or highest price paid to the protected party. In other words, the protected party must take the best price that's offered to it. Finally, as with the mid-market valuation approach, if fewer than 3 quotations are provided, the calculation agent must determine the replacement value based on the same assumptions and using the closeout amount methodology from the 2002 master agreement. This has been a brief introduction to the new cash settlement amount provisions. While ISDA anticipates updating its cash settlement matrix to reflect new market conventions in the application of the cash settlement amount provisions, it's important to stress that the parties will still be free to adapt these provisions to suit their circumstances as that they require them. For now, I encourage you to familiarize yourselves with these new methodologies, and in particular, the various elections that will be required to be made in each new confirmation that includes optional or mandatory early termination provisions.
Chris, thank you. And with that, we end our talk today. Thank you very much to my co-presenters, Patrick Scholl and Chris Arnold, and thank you very much to our audience for tuning in. A few brief reminders. You will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may all now disconnect.